This module is dedicated to breakouts versus fakeouts. Breakouts can be an extremely lucrative way to trade, especially if you catch them at the right time and are able to ride them out. As you've learned, a breakout occurs when the price breaks out of some kind of consolidation or trading range. We have also talked about it occurring when it breaks different levels such as support and resistance, pivot points, Fibonacci levels, and much more. So the goal with breakouts is to get in on a trade right as the breakout occurs and ride the trade until volatility dies down, when you would exit the trade and take your profits. Traders use volatility to make profits, and that's why the Forex market is so attractive. However, a lot of times the market is moving so fast and it's so exciting for traders that a lot of traders try to get in and get out quickly and they lose money. The goal here is to use volatility to your advantage. Instead of doing what everyone else does and jumping in on the market when it's super volatile, it would be better to look for pairs that have low volatility or little price movement. That way you can analyze the pair and get everything ready for when a breakout occurs and the pair gets very volatile. In the next section, we're going to talk about how to measure volatility. I'll see you there.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.